Hey everybody, this is Ryan Mallory, Stock Market Crash Update number 9. You're starting to feel a little bit better out there, right? You're starting to say, hey, maybe the worst is behind us here. The market, since this whole crash began, has spent 5 weeks going down, 4 weeks going up. Maybe this is the turning point. Maybe we got a bottom in here, huh? Perhaps. What we're going to do here, though, is we're going to tackle all the charts. We're going to go through the support, the resistance, the areas of concern. Should you feel optimistic like what it seems like everybody else is feeling right now? Or should you have a little bit more concern despite the optimism? Let's get into it right now. A lot of people are surprised by how fast we've rallied over the last 4 weeks. Since March 23rd lows were put in place, we are up 31% on the S&P 500. Unheard of. A good year, a phenomenal year, the market's up 30%, kind of like last year. We did that in 4 weeks. Yes, the market has sold off a lot too. The S&P 500 went down 35% in just a little over a month's time. You go back to 2008, it took us about 5 months to drop 20% from the all-time high. That's pretty crazy, right? We did it in 1 month. But here's the difference. The market has changed a lot since 2008. Even since the last 4 or 5 years, it's changed a lot. Corrections are priced in a whole lot faster than they were 10, 15, 20 years ago. You have the algorithms and you have the electronic trading that's making it to where we're not depending on the people on the floor to make the trades for us. We're doing it ourselves. We can react super fast, and as a result, you're getting these market corrections insanely quick. That doesn't mean the bottom's in, and I wouldn't go forward thinking that the worst is behind us. We don't even know what this coronavirus is going to be like as we come out of it. How is it going to affect employment? Is everybody just going to go back to their jobs? No, I doubt it. I don't think people are going to go back to consumption the way they were doing before. People are not going to be living high on the hog. People are going to be very nervous because they just went through something incredibly crazy. A pandemic. We haven't seen anything like this really since 1918 with the Spanish flu. And back then, I don't think we stopped working. Instead, I think the consumption's going to be lighter. People are probably not going to go back to their same jobs because a lot of companies are going to realize that they can do more with less. They're going to want to be more careful with their consumption, how many people that they hire. They're going to want to be careful going forward too because they realize how fast things can really get bad in the economy, and so they're going to be a little bit more careful. They're going to save more for a rainy day. Consumption with the individual is going to be very similar as well, as people are going to be very careful about how much they consume going forward. They're going to want to have some money put away for rainy days so that they're not depending on Uncle Sam, because can we depend on them again when we just put $10 trillion into the economy practically? I don't know. I don't think so. I don't think you can just run those money printing machines forever. Now let's go ahead and jump into the S&P 500 on the weekly chart right away. Let's find out what kind of resistance, what kind of support we have overhead, below us. Frankly, resistance levels are getting blown out of the water. There's not a lot out there. You have a major one coming up at 3112. If we get that high next week, that would be mesmerizing. I don't see it happening, but honestly, I would not have expected the S&P 500 to rally as much as it has over the last few weeks. It's just been a phenomenal event. But like I said, the corrections are happening faster, and as a result, you're going to have these rebounds, these dead cat bounces that really take your breath away by how fast and how quick that it can rebound so much of the losses before it takes that next leg lower. But again, you have support off of the December 2018 lows. That's holding now. You have this trend line that's going way back to 2014. It's holding now. You have this long-term trend line that goes all the way back to 2016. That's holding. How about the June lows from last year? Well, we broke back above that last week, and now we're kind of like in this no man's land. It's going to be interesting to see, can the market sustain this rally here? On the daily, it's above the 50-day moving average. But here's what I would be careful of. You have this bearish wedge here on the S&P 500. You have it on the Nasdaq. You have it on the Russell. You have it on the Dow. It's a triangle pattern that goes up. It's very steep, but the higher highs are not as steep as the higher lows. Instead, it's forming this triangle pattern in the shape of a wedge. But what you want in a good rally is to form more of a parallel channel. We're not getting that. We're getting a triangle. And when you get that, they tend to break lower. So what you have this bearish wedge. If it breaks below this line here, I would become very cautious about this market going forward. If you've been riding this tsunami of market gains over the last 4 weeks, maybe start time to be booking some of those profits here and get a little bit more conservative. Been a good run, 31% off the March 23rd lows. Guys, if you're not using stop losses, if you're not trying to make sure you're protecting your downside, you have to do it. Even last week, we still are seeing massive swings both to the upside and to the downside. Yes, it's more to the upside right now, but the fact that even these massive price swings are existing to the upside still shows you that volatility is still elevated, that there is still a lot of potential for another big downdraft. Good markets, you don't see these 3, 4, 5, 6% rallies in a single day. That's not common. A big rally in a normal bullish market's like 1.5% if you're lucky. A lot of times bull markets are really more about fractional percentage gains day after day after day, not these kinds of big gains. There was a lot of panic selling, and now you got a lot of panic buying. That's what we call the fear of missing out. People are weary of missing out. They see Netflix going up, everybody jumps into Netflix. Everybody sees Amazon going up, we're all jumping into Amazon. We like Clorox, we like Zoom, we're all jumping in there at the same time because people are fearful of missing out on some kind of potential. They're scared right now. They don't know how to interpret the market, so they're just going to do what everybody else does. You got this crowd mentality just piling into anything that everybody else is getting into right now. Eventually, the smart money sells out to the retail investors like yourself. They get out and you're holding the bag as the market goes back down again. Another thing I want to talk about is this 11:30 market rally. I don't know what it is. I don't think I've ever seen it before, but it's happening every day. We make new lows on the day, whether it's a gap higher and we start drifting lower and giving up some of those gains. We tend to bottom out, but somewhere between 11 and 12 o'clock on average, it's about 11:30 Eastern time. And then all of a sudden we just rally back the rest of the day. And then you get the 3:30 ramp where things just go absolutely ballistic. You had that on Friday. You had it here on Thursday, right? We bottom out at this 11:30 period, and then all of a sudden we just rally back up again. And then we don't like to break those morning lows. You can see back on Wednesday and Thursday of last week, we kept testing these lows time and time again. We couldn't break them. And then all of a sudden you just rallied up. And then you got these gaps. These gaps in the charts, and I'll pull it up on the SPY because it's a little bit easier to see. These gaps are meant to be filled by price. These candles here, they tend to fill those gaps again at some point in the near future. You have gaps all over the place going back to the 6th of April. You have it here again on the 14th, on the 15th. You have it on the 17th. There's gaps galore. They get filled at some point almost every time. Charts hate it when there's price gaps left unfilled. What you're seeing right now is a moment of reckoning for the stock market. 1929, we had a little bit more of a 50% retracement before we took the next leg down. 2008, we had more than a 50% correction, but it wasn't quite the 61.8% retracement. Instead, it was somewhere between the 50 and the 61.8%. That's kind of where we're at right now. Again, can you depend on historical analogs to guide you in the future? Not to a T. Every correction has its own personality, but we can use it as guidance for how steep can these corrections go before you start thinking, okay, maybe we're just going straight back to all-time highs. But again, and I said this in the last video, if we go right back up to all-time highs, my belief is there's never a reason to short the stock market ever again. If you can shut down a global economy, be down for basically for business longer than you've been open in the year 2020, and you can have the Nasdaq that's actually trading positive on the year, what do you need an economy for? You just turn the money printer machines on at the Federal Reserve and just watch the market go up every day. You don't need to work. And here's the funny thing too, there's not a lot of people that are talking about more downside in the stock market. I know there's a lot of you guys out there, I read the comments, so I know you guys are all about that. But in general, you turn on the financial news networks, you turn on CNBC or Bloomberg, there's very few people saying, hey, I think we're actually not going back to all-time highs. I think we're probably going to correct, maybe even blow through the lows. I still actually believe we're going to. I could be wrong. I've been wrong a lot in the past, okay? As a trader, I'm not supposed to be right all the time. You can't be, okay? You try to project where you think the stock market's going to go from your own experiences trading the stock market, from what the charts are telling you. Most of the time where these rallies where they just go insanely bullish, following a major dramatic hit to the markets, they don't last. And so while I'm surprised at how high it's gone over the last 4 weeks, the market does what it wants. It doesn't care about what I think, and it doesn't care about what you think. But I have to be ready for when it does make that next turn lower. And if it doesn't, then I have to adjust my strategy accordingly. There's nothing wrong with being wrong in the stock market. It's only wrong if you stay wrong and you don't adjust your strategy to what the market's actually doing. We talked about the Nasdaq 100 earlier. It's up over 1% on the year. Nasdaq 100 is your stocks like Apple, like Amazon, like Facebook. Those are your big names that are in the Nasdaq. Amazon and Netflix in particular have been skyrocketing. The index is like, Corona what? It doesn't care that the economy shut down. It's just going straight back up again. I don't think it lasts either. I think you got to show caution about trying to chase price in the NDX or in the Nasdaq names like Amazon and Netflix in particular. Because even when the market thought that there might be some kind of drug that will help get people back to work faster, what happened? Netflix took a hit. It was down 3.7%. AMZN took a hit, 1.3%. The S&P, on the other hand, it was up 2.7%. So it lagged. That's because when the market does start getting back to normal, the stocks that ran higher, particularly like the Roku and Zoom and Netflix, they're going to take probably a hit until things get back to a little bit more fair value for those names, because they've been running up like crazy due to the fact that everybody's going to be using their products more because everybody's at home. However, going back to the weekly chart, I want to bring up the IWM. This is the Russell 2000. These are your small cap stocks, typically under $1 billion. It was down 1.4% on the week. Small caps didn't participate in this rally at all. You had the S&P 500. It was up 3%. But you take the IWM, it didn't. It lagged. You take the Nasdaq, it was up substantially, like 7+%. Small caps didn't join the rally. And why is the S&P 500 going up so much? That's because the top 5 stocks comprise about 20% of its momentum. That's your Apple, Facebook, Microsoft, Amazon, and Google, or what they call Alphabet now. They have a huge influence on the market. In fact, I think it's like 22% to be exact of the S&P 500 market cap. So when those names are going up, it's going to push the whole market up. When you take Apple, what has it done? It's rallied for the past 4 weeks. It's gone from this week alone from like the 267 area all the way up to 282. That's a $15 gain on a $282 stock. Now, you know I like to talk about the VIX each week. It's down 4 weeks in a row. Not surprising, the S&P 500 overall the last 4 weeks is up. However, when you look at it in terms of elevation against the historical norms, going back to 2018, guess what? It's still above average. In fact, where the VIX is sitting at right now, it's still the highest since 2011. And when you look at it over the last 20 plus years, the VIX is still quite elevated. So what you usually see when the VIX starts coming down, you see a rapid descent on the VIX. Really not quite happening there. Yes, we were trading as high as 84 and we're now at 38. When you look at the daily chart, it went straight up and it's been kind of like stepping its way down lower. It's not taking the elevator down like it took the elevator up. Instead, it's taking the elevator up and the steps down. So yes, you have this bull flag here still on the VIX, but if it breaks out of this bull flag pattern, you could easily see the VIX start to push back into the 50 and 60s again. That's going to require the S&P 500 to take that next leg lower in the market. Now, let's go ahead and take one more look at the Nasdaq 100 here because I want to introduce the Bollinger Bands here. Bollinger Bands are simply a 2 standard deviation of the 20-day moving average. That's how I use them at least. When they get outside of the upper Bollinger Band, you're going beyond 2 standard deviations in price. We saw that this past week in the Nasdaq 100. You saw it in the Nasdaq itself. What does that tend to happen when we get outside of the upper Bollinger Band? It tends to trigger some profit taking. We got it right before we had this huge move lower in the stock market due to the coronavirus. We had it there, and then all of a sudden, a couple weeks later, we're selling off. But a lot of times, it's actually more instant that we see the sell-offs, right? You had one back here in December 2019, and it led to a 3-week sell-off. Now, none of it's as dramatic as like what we saw, here in February and March. But you see them all throughout history where a lot of times it gets outside the Bollinger Band. You start seeing the shorts come in and start shorting the price action, hoping to get a little bit of a profit-taking moment in the markets themselves. So be wary of that, okay? Not saying that that's going to trigger a sell-off right away. I'm just saying that you're seeing conditions that are arising from the extent of the retracement to being outside the upper Bollinger Bands, to some divergences happening in the Russell where it's declining while the large caps are going up. There's a bearish wedge that's forming on the daily chart. Definitely some areas of concern out there. The market's really not looking at what the quarantine's going to be like after the quarantine's lifted. Are people going to go back to their normal hiring practices? Are people going to go back to their same consumption habits? A lot of that's going to change, and it's going to be reflected eventually in the earnings. And similar to what I say a lot of times with you guys, whether it's on my podcast or in previous videos, the rally's great. The rally's phenomenal, okay? I mean, people aren't going to argue with a 31% rally over the last 4 weeks. If you got into it, obviously hardly anybody probably got into it at its lows, but if you held through the whole decline and you've experienced the huge counter trend rally, it feels great, okay? You've seen a lot of your gains come back. However, you still have to manage the risk. If you're not managing the risk and all this stuff, the 31% rally is for nothing. Okay, that doesn't mean you go and sell out all of your long positions right now, but it does mean that you start drawing lines in the sand. It's like, okay, if this market does decide to go back lower, where am I going to get out at? Where am I going to draw the line at? Okay, because who wants to see another 40-50% decline in their portfolio? But you have to be prepared for it, whether it does happen or not. You have to be prepared for it. And so just as important as knowing where to get out is knowing where to get back in at too. If you're not in this rally, it doesn't really make a lot of sense to start chasing a 31% rally now. Instead, be diligent, be patient, wait for good trade setups to come your way in individual names that's supported by the overall market action. In the end, we all want to feel good about the stock market again. We all want to hope that, okay, I don't have to pay attention this close to my 401k or my RRAs anymore, but you really should. You should always be watching it, whether we're in good times or bad. But A lot of you are watching these videos for the first time because you've never seen anything like this in the stock market. You're looking for somebody to help you or to give you some advice or some experience, or somebody that's been through it like I have, going back to 2000 and 2008 when I experienced these things firsthand in 2018. More times than not, there's another leg down. We saw it in 2018, we saw it in 2008, we saw it in 2000. These dead cat bounces, they eventually run out of steam. I hope it doesn't. I hope it goes straight up to all-time highs. I really do. But if I'm being realistic with you and myself, I got to know that this 31% rally isn't just a march right back to all-time highs. And if it is, well, it just made things easier for me because I never need to short a stock ever again, because this doesn't lead to a major sell-off, shutting down an entire economy. I don't know what will. What in the world is out there that could actually do that besides maybe nuclear war? I can't think of it. So if the market can shrug off a non-existent economy, then I guess it can shrug off anything. But in the end, manage the risk. Look at opportunities that give you smaller amounts of risk for much more potential upside, and you should be okay. I hope you've enjoyed this video. I know I enjoy making them for you. There's a lot of love it's put into this. It's a labor of love, but it's also something I'm very passionate about. I really ask that you like these videos and subscribe to the channel so you can get notified of when I post a new one. I'm trying to do about 2 every week. It really means the world that you guys have been able to support me through this, and just keep on supporting the channel, and I'll keep on grinding out this good content for you. Thank you, and God bless.